Well, hello, everyone, and welcome back for another scintillating edition of the most dramatic ESG podcast perhaps ever, Armchair ESG with Nate and Yates. I'm Rob Yates, Director of Communications for Owl ESG, and with me, as always, my partner in crime, Nate Najara. How you doing today, Nate?
I'm doing great. You look awesome with the tie. You're one-upping me every single podcast.
Well, I was going to say you look slick in the jacket, and I'm trying to class this place up because we had a guest a few weeks ago who classed it up so much. I'm trying to match him, and we brought him back, Mr. Conor Platt. How you doing, Conor?
Hi, everyone. Thanks for having me.
Oh, we're thrilled. Thank you for coming back. Conor, CEO of Confluence Analytics. We've done a lot of analysis work, our data and Confluence's overlays, and well, I'm going to oversimplify it, so I'm not going to even pretend to try. But what we talked about last time was if we really want to get serious about changing our investment patterns in a way that could ostensibly bring us to net zero or some significant reduction in emissions through market-driven processes, you have to do a couple of things. One, you got to verify offsets. We've established that we can do that. Two, you have to set a price for carbon. And I don't just mean setting a price for carbon. You have to build carbon pricing into the market so the market can react to it. And that's what we talked about last time. But of course, even the most risk averse investors are looking for a return. And so we're bringing Conor back for the next step in this discussion. How can we look at and carbon or Conor coined a term that I love. It's carbon adjusted yield. This makes a lot of sense. So Conor, can you speak to the audience, tell them what we're doing here?
Yeah, sure. So we talked before about that all indices, and we use the S&P 500, I think, in our discussion, but all indices or portfolios of stocks produce emissions, and at the individual stock level, we focused in on dividend paying companies because almost all investors want some dividend yield. And if you are a sustainable investor, a dividend yield is going to lead you to industries that are very carbon intense. And there's, it's just hat in hand with how that works. And so what can a sustainable investor do? And how could they look at different stocks from a dividend yield as it relates to that company's net zero profile? And so we kind of borrowed a standard way of looking at dividend yield stocks, looking at your after-tax yield. And in this case, we sort of replaced the tax with a carbon cost and look at the cost of, and we'll get into a little bit of the details with some examples, but we look at that cost and then net the current dividend yield to that cost. And what you'll see is that depending on the company and depending on the market cap of that company and a few other variables, the impact of net zero on a yield. And we can get into that more in a minute, but it's really a straightforward way to gauge the cost of emissions at the company level for income investors.
So let's break a couple of things down for people that might be in one of these worlds or have straddling a couple of these worlds. When you say income investor, don't all investors want income?
Yes. Well, growth investors.
I'm messing with you.
Yeah,
Can you explain what we mean
growth
by that?
investors. Well, now they do. All investors want income now, right? But it's absolutely true that the most conservative investors looking at equities would start with dividend stocks. And what we did in the paper is we started with a product that is constructed around dividend paying companies that have done so for 25 years or more. So the starting point of the universe and the ETF we looked at is NOBL. It's the ProShares Dividend Aristocrats ETF. And the whole point of it is to have a collection of long paying dividend stocks. And what we did is then looked at that portfolio and focused in on the sectors and industries that tend to be the most carbon intense, and profiled a few of those companies and did a net zero dividend adjustment. And I don't know, Rob, if we want to pull up the example companies, because we can kind of walk through. I think everyone will recognize most of these companies, if not all of them, they may not appreciate how carbon intense they might be.
And
Excellent.
so this is an important point. So before we dive into the fact that people looking at this are going to say those don't look like what you would normally tie to sustainable investing, but these companies that pay these dividends, you mentioned, have a 25-year history. There's a whole lot of things that sort of work together there. They're old established companies with established operations plans. So for them to take direct action to reduce emissions in their operations is very often a much more significant undertaking than a company that just starts new operations in an emissions friendly way.
Absolutely. Yep.
So you have these blue chip names, they've got these operations established, but the upside and the reason so many people want them as a significant part of their portfolio is, like you said, they pay very reliable dividends. And you can take those dividends or you reinvest those dividends and it builds and builds over time. And so then you have, as you can see on the screen, what are we looking at here?
So the first company, they all are very carbon
yeah.
intense. Archer Daniels Midland is the
Food,
first
right?
company we looked at. Nexera Energy, the largest electric utility, and actually known for a lot of its sustainable practices, but it is the largest utility in America. And then ExxonMobil, the largest energy integrated oil company in America. And so these three companies sit in the product that we started with, and they are in the most carbon intensive sectors for that product. ADM is probably the one that people may or may not know. Archer Daniels Midland, it's a large agriculture company. And for the folks at home, agriculture is very carbon intense. So just walking people through this, ADM pays a dividend of about 2.5%. And from their filings, they claim to have about 15.2 million metric tons of carbon produced in the year 2022. If you take that amount times a carbon price, in this case, we're using a price in the 20s, you then divide.
This is, can I jump in real? Because this is a really important part.
Yes, please.
You had reason to go with the $23 that I actually don't think is relevant here. But the point is, we've established a baseline price for carbon here. So the market can react to that. It's not arbitrary. Someone else or the market or whatever it may be comes up with a different price. Maybe it adjusts a little bit, but these are reasonable prices that people can work with.
We can talk to our price, because the last time we spoke, we showed a few different pricing benchmarks. We showed regulated prices and we showed voluntary carbon prices. And essentially, projects in carbon exist in the spectrum of prices in those ranges. $23 is roughly a price we're sourcing a bunch of carbon that also has additional impacts beyond carbon, so social and other impacts. And as we touched on, really get at the heart of some of the issues that have plagued the carbon markets historically, which is transparency and traceability.
100%. And that's actually why I mentioned it, because the dollars are real dollars, but we're about to translate to percentage so that there can be a basis point calculation.
Correct. So if you took that $23 times 15.2 million metric tons, you would get the total cost of being net zero for ADM in the year 2022. And if you take that cost over the market cap, it results in a net zero expense of about 88 basis points, which is pretty considerable. And that is the point, is that ADM is a very carbon intense company based on the industry that they are in. And the market is attributing so much value to that carbon. And that's why you'll see that ADM's net zero expenses, in fact, higher than ExxonMobil, despite the fact that ExxonMobil produces, a factor of almost 8 to 9 times what ExxonMobil does. So,
can I point one other thing out here? Because this is what blew my mind. This is where I think this plan is brilliant. if you weren't looking at the dividends here, ExxonMobil would have a higher cost of carbon because it's not distributed over anything. It's just simply a higher cost. And
Correct.
those costs can become prohibitive when you look at them. They're not relative to anything. It's just, hey, this is what it costs to go net zero. What you've said is, okay, look at what your dividend percentage is. Look at the basis point cost of carbon. Now take the two together, we can distribute it against something, and you're not making as much money as you would have, but it doesn't mean your returns are lowered because part of your returns is now working towards net zero.
Correct.
Do I have that right?
You do.
Okay.
And this becomes most relevant when you're looking at a bunch of companies in the same sector. So for investors, in this case, this product is picking the stocks, and we pick the most carbon intense to show the example. But when an investor could use this when they're looking at stock A, B, and C from the same sector, and they would then be able to look at their net zero yield, effective yield, and it would give them a pretty good indication of how carbon efficient though that company is, both in cost and then how the market is attributing value to the company. So, if you were looking in the energy sector, for example, at stock A, B, and C, in this product, there's only two energy stocks, and they're the two largest, Chevron and Exxon. But you would be able to better judge, for example, which company would be more attractive based on a yield adjusted for a real cost. And really, that's what this is about, is bringing this in terms of a cost relative to in terms that investors are used to dealing with.
Yeah, one of the things to jump in here, Connor.
Yeah, absolutely.
Yeah, one of the great things about using dividends as an ESG metric that I think is important, and I want you to elaborate on it. Part of the theme of this podcast, between Yates and I, is let's let's look at the reasonable solution, right? Let's not play a zero-sum game when it comes to ESG or sustainability and return on investment, ROI, right? There can be, a reasonable path forward. And I think this helps with that because you have sustainability investors on one side, right, that are looking for companies that are green or that have low GHG emissions. And then you have companies like, ExxonMobil, ADM, that are great for investment, income investors, right? Just steady returns, great returns, very predictable. And by using this, we can bring these two together by giving them data, factual data to say, hey, you can still invest in an income stable company that's traditionally, carbon heavy, but with offsets and with looking at this dividend yield, you can actually help and make money at the same time in a very reasonable and responsible manner. Do I have that correct?
You do, but I think that also what's going on is, let's just say both these groups do want to actually interact, right? So institutional investors and sustainable investors, and they interact through this mechanism that if you are trying to create a dividend portfolio in the United States of America, you can avoid owning Exxon and Chevron, but it'll be impossible for you to avoid owning carbon emitters that are very intensive. You may not be aware that ADM is so carbon intensive, but that doesn't mean it isn't. You may be aware that ExxonMobil is quite carbon intensive, and and choose not to invest in it for personal reasons. But from a portfolio construction point of view, if you eliminate a set of stocks, which is the investor's right to do so, it does limit your yield components, and it certainly does impact your returns as it relates to other dividend stocks. If you're reducing the number of companies you can use, the best you can do is be very active in your positioning, and you got to get a little lucky. So this allows institutional investors and sustainable investors to at least make a better informed decision. And for the investment community, it begins to move carbon into this externality with a cost. And I think what we've seen over time is, as OWL has grown and ESG has expanded, we've moved beyond this this, hey, these things produce emissions. Well, what are we going to do about it? And what is the cost of that externality? And depending on your investment point of view, that's a topic that's either very, very, long past due, or just something that better to interact with both. And I think this is a good way of coming at it. It is also surprising, as you move away from the carbon intensity, how little impact certain companies have. And we showed this in the report. I'm sure we'll get to it later, but Procter and Gamble, a company that people know well. That's a company that when you do the same analysis, it produces a lot less emissions based on the industry that it is in, but emissions nonetheless, and its effect on the yield is very limited.
Yep.
So it's an example of whether you are a sustainable investor or a institutional investor that doesn't even view these externalities, that is a company that everybody would be on the same page on, and people would be surprised. I think the cost there is like 2 basis points on a yield. Similar J&J, we go through all these companies, but it gives people various flavors of what, thank you. So these are a bunch of names that most people know: 3M, Emerson Electric, J&J, and Procter and Gamble. And you can see 3M, there's a lot of things around 3M at this point, but putting aside forever chemicals and litigation, which is part of the reason that 3M's dividend is so high, on a regular day, or a regular year rather, 3M produces about 4 million metric tons of carbon. And the cost of that is about 16 basis points in total. And so your yield is still a very attractive, or super attractive 5.7%. There's, ongoing concerns about the company's financials state based on litigations from PFAS and various other things. But, when you look down the line, and I think this was sort of the point I was making, Emerson Electric and Johnson & Johnson, you can see that these are companies that really, while they're huge, based on the industries they're in and other factors, they are not that carbon intense, and the effect on their yield is minimal. And it's just another way of another example of that. Much of this change is really not that expensive.
I love how informative this is, right, for investors. Right, you're looking at the net zero yield, but then you're looking at dividend scope 1, and it makes it easier to compare and contrast. So yeah, sorry I didn't mean to interrupt there, but
no problem. And the nice thing for every kind of investors, particularly the skeptics, is this is all of these numbers are very public information. We get data from OWL, obviously, on admissions, but you can just go right to companies' sustainable reports and get these exact numbers. And scope 1 and 2 emissions, as we discussed in our last topic, these are now mandated by law to be published every year. But the S&P 500, over 90% of the S&P 500 has been doing that for 5 to 8 years. Scope 3, which we talked about ad nauseum last time, is the moving target. But even scope 3 emissions are things that many companies are publishing and putting out.
And even so, to be fair, if you offset all the scope 1 and 2 emissions in like the S&P 1000, be a big emissions reduction.
It would, yeah, exactly. And it's, as you touched on earlier in this discussion, companies are obviously implementing their own sustainable programs for various targets and for various reasons. If a certain group of investors are also engaging in net zero activity, you can see how over time that in the middle you get a lot of bang for your buck. And certainly scope 3 emissions, if you're reducing scope 1 and 2 emissions, it has an effect on scope 3.
So here's what I love about it. And you touched on something there with the 3M lawsuit, right? Granted, we're not distributing cost of emissions against lawsuit payouts, But anytime you make an investment, there's a risk. There's always a risk. And I'm not going to try to give a lecture on risk because there's people who do it exponentially better than I could imagine. But the point is, there is a risk with every investment you make. So 3M, lower on the carbon emissions. Oh, turns out there's a foreign chemicals in the water, in the rivers risk. Johnson & Johnson, almost no expense for emissions, but there are other risks, recalls, things of that nature.
Talcum powder. Yeah.
They're exactly. So when you use the term climate adjusted yield, what I liked about it in particular is it's investment language, because every yield, every return is risk adjusted return, risk adjusted yield. It's inevitable. And so all you're really saying here is we can price not really emissions directly on paper, but what you're pricing is climate risk. And it's not perfect. I mean, there are other aspects of climate risk, and I'm not saying we've all of a sudden found the holy grail of like, what's climate change's risk coefficient or something, but you can now factor it in. And so if you want to be a sustainable investor and a long-term investor, not only can you put ExxonMobil in your portfolio, there's actually incentive to do it, and then perhaps engage with the company as a big shareholder if you want, and say, hey, here's the climate adjusted yield. Start buying these offsets.
I think, Rob, the favorite part of the document that you sent, that Conor sent over is, and I think that's what you're trying to say, but it sums up, it is surprisingly affordable to have your sustainability cake and eat your financial returns too. And I love that comment, because you're right. Now you can go to an ExxonMobil, invest as a sustainable investor, and then work towards some of these, GHG emission reductions, and just help out, right? Instead of being against it, you can be for it with this real input of data, right, against predictable returns. That's really fascinating.
Well, yes, and then it's always the case too that people just happen to know these names, right? These are 3 or 4 of hundreds of names in portfolios, and the real point is, whether you're a sustainable investor or just a regular investor trying to make a buck, you really need to pay attention to all of these risks. We touched on a bunch of that end up being financial risks that are very ESG related, not necessarily climate per se, but and whenever you're engaging in investing, is the more information that can quantify risk and put price to things, the better. Particularly when comparing against company A and B in the same sector, then it's just another metric, another good way of looking at it.
And we're talking literally about dividends as an ESG metric. And here's there's another aspect to this. So Nate, I appreciate the shout out. If anyone wants to go, owlesg.com. I just published an article on this too, with Conor's support and them sending over the graphics. So Nate was quoting my article, which is heartwarming. But the article does focus on what we're talking about here and how it applies to income investors, so that sustainability investing and income investing, or long-term investing, there's a natural way for them to work together. But there's another aspect to this. In the political ESG fight, where everyone knows the right words to say and none of them know what they're talking about, I think. One of the big restrictions is, and it gets weird and technical, but like one of the big fights was over whether or not an investment manager is required to only consider pecuniary interests in making investments for someone. And the argument was that ESG is not a pecuniary interest. And I actually think there's some substance to the argument, because a lot of people did a very bad job of trying to define what the financial downsides of not considering ESG risk are. What you're doing here is no different than incorporating some other cost of doing business or some other cost of risk, and that's your risk adjusted yield. So now we're saying, okay, it's still a pecuniary interest, but this is a long-term strategy. We want to take these things into account.
Yeah, we do, as we kind of talked about, we also then do the messy part of taking ESG data and look for patterns and relationships with residual returns and try to treat ESG as a factor and warts and all. And that then gives you a real sense of how much changes in ESG data affect the forecasted 12-month return. And people may think all this stuff's voodoo, but essentially it's just another way of putting a bunch of costs and then putting out a prediction and seeing how well you do against that prediction over time.
That's it.
And, you know, I think the issue for everyone with ESG is that when ESG issues come up, they're rather messy and they take a long time. And 3M is a great example. This litigation has been going on for a long time and more to come. And if you're an investor in this, you hope it's settled, but maybe not, So, and if you're invested in chemical companies of all stripes, you know, this is a risk. This is just out there. So I think that what's very helpful is that by putting a real cost and putting it out there, it causes people to think a little bit and push back and adopt or however they want to look at it. We certainly think it makes it much simpler to say, hey, this is kind of the effect. And if you wanted to do this across a whole portfolio, what you'd see is depending on the construction of your portfolio, it would follow that the more carbon intense you get, the slightly more expensive the offset would be. But you may, and we talked about this previously, we know that ESG, sustainable investing, whatever you like to call it, will have made it if it's something that you can be underweight and overweight, right? As soon as you can be underweight something, then you've made it. How you know you've made it as a factor.
Yeah. How's the market? How are your clients? How's the market responding to this dividend as the ESG metric?
Well, this is hot off the press.
We're bringing we just opened the curtain.
Yeah,
this is the first show.
I would say that the way we previously displayed this information is more at the portfolio level, and so what people would be looking at is this whole portfolio, but we're saying, hey, it's this metric tons of carbon, this cost, right? When we look at it, and that's actually the proper way to do it, is that when you're looking at a portfolio, not every company in a portfolio is going to pay a dividend, right? And when you're looking at that, then you need to do it at the whole portfolio effect. This is just a way, kind of a shorthand way of saying, hey, this is roughly what the cost would be net of the dividend. And so if you were to use the dividend to pay the cost, for example, right? Yep. And that then you would have to allot this much. And currently in the States, you don't really get a benefit other than personally to offsetting your carbon. But it's our belief that over time, there will be some benefit beyond personal. And generally speaking, for sustainable investors, people that want that action or are choosing to do certain aspects and how they want things to go, that step is very important. And it really kind of finishes the process. And I believe it's kind of the missing link or missing piece of sustainable investing. It's just not really satisfying enough to either be allocated a certain way in a portfolio and avoiding stocks you want to avoid or whatever your setup is. There's also this desire to have an action step and to make an impact. And so,
not just for sustainable investing now, because there are people when we say sustainable investing who that's their focus. Yep. But now if you're a retail investor who's active in your portfolio, or you're just looking for funds that you're a little more comfortable with, you can invest. You don't have to consider yourself sustainable, and you can still get a reasonably predictable, very stable, consistent return comfortably while your money is going to things that make you feel better.
Yeah.
That's a big deal.
Well, especially in this
I think
environment,
so.
everybody's chasing yield, right? Or you're chasing yield anyway, but especially in this environment, chasing yield is important. So
I
this
think
is absolutely brilliant.
people have been
Yep.
chasing yield since yield existed.
That's right.
That's
right.
that's like that's the whole game.
Yep.
And and as well they should. And this is just another way of looking at it, just as using taxes as an example, people use an after-tax yield when comparing municipal bonds because that's
right.
the effect that income is having. And this, in this case, is we could layer in some other costs into that dividend if we wanted to, risk, other things. You could use your dividend to hedge the stock, right? The other way of thinking about it is, hey, I have hedge funds do this all the time.
Yep.
Use dividend to put protection or other derivative strategies around a position for whatever reason they determine to make sense. And, it's just another way of using the income from your dividend. That is not a foreign concept to regular investors that, I have 50 basis points of yield I can use to hedge the market. That may be something that you engage in. It's certainly stuff I've engaged in my professional career. And
I also think you hedge climate risk, which again is a little more nebulous, but we've at least started to put numbers on it. But when you look at a company like ExxonMobil, and they have something like I'm going to get this number wrong. I'll throw it up on the screen if I get it wrong, but it's like $13 trillion in estimated carbon untapped assets. But if ExxonMobil is forced to abandon some significant portion of that for regulatory reasons, for example, you've lost a lot of, a $6 trillion write-off. Not many companies bounce back from that. And it's more complicated than that on the books, but like climate risk is a real thing for an investor. Now you're hedging against it. So it's not just the financial the climate hedge is what I'm saying is also a financial hedge. It's not just making some investment ploy to try to not ploy, but strategy to protect your money over time.
Yeah. And actually many of those write-downs occurred in the last few years across many oil companies. And then once again, as people had to jettison Russian operations, this is always a moving target. And, reserve risk is a topic. Actually, it's funny. I haven't heard somebody mention this in a while, Rob, that, Exxon may not be able to pull everything out of the ground.
I spend so much time working in risk.
No, I know. I look. It is a risk. It's a risk actually independent of climate. It's a risk of if you own an energy company. We'll put Exxon aside here for a minute. Do they have the cash flow capacity and ability to pull all the oil out of the ground? Yep. That's the other question. It is a cyclical business. If you invest in energy, putting aside sustainable investing here for a minute, you are investing in a very cyclical business that is difficult to run and has operations and deals with places and parts of the world that are not ESG compliant in any way, shape, or form.
Well, to be fair, you're getting into a cyclical, but when it's good, it tends to be really good.
Oh, yeah, absolutely.
But when it goes bad, it tends to be absolute.
It's been interesting, just looking at the returns of energy of late. Over 2 years, you've done very well, but year to date, you're down. It's a very it's been a strong performance, but it's not been as sustained for a variety of reasons. But nonetheless, every company that pays a dividend for 25 years, that they, are well run enough to do that in various industries. And we sort of highlight in this piece, I think the average company in that particular product was like 43 years of paying a dividend. That's just a whole different animal from what people are looking at in an index, right? So,
and so I think that's a really good final thing to discuss is we have now reframed the conversation. You can be sustainable and the entire breadth of investment possibilities is open to you. And I think that's important because, like you said, energy companies the good ones get very good at producing energy, at getting energy out of the ground.
Yeah.
And here's a fact, and like there are people that don't like hearing this, but it is 100% true. Certainly, some of us have discussed this more than once. If we really want to look towards a net zero or near net zero future, we're going to have to burn a lot more fossil fuels. There are a lot more emissions coming for that technological and for innovation. There's work. Work requires energy. Unless there's people out there just cranking wheels all day, or spinning a bike like we're on a Black Mirror episode, then you need to burn the fuels to get that energy. With this, it's okay to do so. Hey, we can incentivize you burning more fuel to drive innovation because we know it's totally being offset, and
Right.
we are accepting the cost of the offset as a way to put off the risk. Like this all works together. It's not perfect. Things are going to go up and down, but it all comes together.
Yep.
Now, a lot of people will push back on the offset and other things, and that's fine. Just putting a price to it, having a price to emissions as a financial market in the US would be a sea change on a lot of levels. It would also hopefully spawn some new industries that are about not just solving this issue, but actually helping people profit from it. Maybe perhaps empowering people to have assets and produce carbon offsets themselves, which is something that we have in the works in our neighborhood, hopefully. But yeah, it's also that if you're going to invest, you're going to own the S&P 500, you own every one of these companies every time, right? And it's nice that you might know that you don't like Exxon, but
people probably don't know that.
Yeah, well, people, there's a lot of things that they don't know, and they don't do this every day. So that makes a lot of sense.
How many of them get a proxy statement once a year and then throw it in the chat? What is this?
Well, a lot of professional investors do the same thing too. So
fair enough.
At the end of the day, if you're going to end up buying 100, 200 companies in these products, there's no way that you're not getting in some bad actors, and certainly anything that's growing is admitting emissions. And so it's more that you have to have this systematic way and put it in the language of most of the investors. They can ignore it, but if it's there, it's there for someone. And then yes, in terms of the way we sort of look at things, if you can put a cost to something, then you can get more efficient and bring that cost down, and you can improve the output. I know this is a conversation for a later time, but essentially over the last 2 years, and Al has been very supportive in this, Confluence has been involved in different aspects of the digital carbon space. And in the long story short, there is essentially you take assets, you improve them with technology and satellite imagery, and you make them traceable through some type of blockchain ledger. And when you combine those three things together, you can create something that looks very much like an asset, and an asset that you have the transparency level at a monthly basis to see the various impacts. And the nice thing is that the impacts can go way beyond carbon. And that actually
100%. Where people different potential ESG assets that you trade.
Yep.
Yep.
It's taking a while for those assets to get the infrastructure and the technology lift, but when those hit the market more and more over the coming months, years, we hope to be in a position to be putting those together and helping investors do this as a service. And I think that over time, this will just become another thing you hedge out of your portfolio to one degree or another. And this may be something that over time you get some tax benefit for doing so. And the view is that companies are doing really incredible things in terms of the scale of their operations to improve efficiency all the time. You don't pay a dividend for 43 years without figuring out how to be efficient. And so, right, I mean, that is the game. So these companies are doing that. And you as an investor now have an option that isn't actually all that expensive. And if it
And here's,
allows,
yeah. Go
say it
ahead,
again.
sorry.
Yeah.
No, go ahead.
If it allows you to better attack the investment problem, which I think advisors are kind of, they're in a tough spot because they really haven't been given the tools and they're being asked questions. Also, investors, they don't know how to process 140 stocks. That is not something that they should want to feel like they should process.
Yeah.
You gotta
concerns if you are. Yeah.
Obviously, there are people like me and others that love doing that kind of stuff, and so that's making this much more practical and making this about, hey, these are the numbers. You can put a different cost to this. You're still going to get to some ballpark of what I'm talking about. And the more, as we've seen in financial products, the more people that start to look at this and incorporate it into their thinking, the more the market will begin to adjust to this, essentially. So we need to invest more in these companies.
That's right.
All kinds. I mean, that's part of the issue, is that dollars need to find great places to return their capital. You were going to say that, so
no, I was when you started talking about wealth managers, that's exactly where I was going. So we're on the same vein. Is one of the things we get challenged a bit on. We're not challenged, but it's interesting. Sustainability teams or your ESG team. ESG data is great. The environmental data is great. Oh, here's my GHG emissions, my scope 1, scope 2. Wealth managers are like, well, that's great. What am I supposed to do with that? What's the action behind having this data? And with this, by combining traditional investment data or dividend data with environmental data and deriving an output and making that actionable is exactly where this industry needs to go. And I really believe that's going to help sell to wealth managers or investment advisors. When you have that, hey, here's the empirical data, right? Here's how it works with, the investment data. And here is an outcome that you can make decisions on and be sustainable, but chase yield at a maximum output. So that is brilliant all the way around.
Imagine the market, if that gets uptake, imagine the market that creates, like Conor, you alluded to, and I don't want to spoil anything, but I'll get you on to talk about the offset stuff too in a few weeks. But $23 isn't an arbitrary number, but it's not a set number either.
No,
when there's a market that is competing for carbon offset sales, that is forced to innovate and become more efficient in delivering its offsets, but still held accountable through, like you said, new technology. We have blockchain verification, satellite overlays, all sorts of other things. Imagine that cost of carbon drops from $23 to $15 or $12 or even like $8. Now your net impact distributed over the entire market cap of a company and calculated as, again, climate adjusted yield just against dividends is it's approaching negligible.
Yeah, and essentially with the carbon prices, I mean, where this market is very early innings still, in terms of flows and all of that. So what you would expect, just like energy, that carbon prices, carbon offsets will begin to mirror in some way energy prices. And the way they do price on a regulatory standpoint is they price off the natural gas spark spreads, essentially. And what that means in English is that they basically price off the marginal cost of turning on and off a power plant with natural gas is the way to think about it. And the reason they trade that way is because the power plants are the biggest buyers of regulatory credits. And, and what you will see, and this, I don't know when exactly this happens, but just like anything else, once it becomes used more, it will have a more variable pricing. And many, one last thing, carbon offset prices in general over the last few years have been higher for several reasons. but one of the reasons is this war. So, and hopefully that can stop soon. But that is a big component of it. And then the other component of it, which is going to be kind of fun, is that these projects are unique and different. And so I just saw, this is kind of local to here, but there are carbon credits that trade on the city forests around the country, and actually quite a number of them from where I'm from, Pittsburgh, Pennsylvania. And I really look forward to building financial products where I have soil credits from Elizabeth Township, Pennsylvania in them.
Wow.
Like that. And I think
you support those local projects.
The local project.
That's actually a critical point, because the amount of space available in local projects distributed around the country and around the world is way better than some mass. Like we as humans, I think, instantly think of like some big solution from the top down, like, oh, they have 4 million acres and they're going to plant this many trees against this. But the truth is, if you look at every Elizabethtown that could do this across the country, you get a whole lot more area.
You'd start to, yeah. I mean, this is all early days, but I think from the advisor standpoint, they're very comfortable selling portfolios and the outputs of those portfolios, right? Return, risk, emissions being another thing. They actually would be fantastically brilliant, if we can use the expression, at selling these solutions. Because if everything else lines up, and it is, as we say, it is traceable and click through, you can see everything, that actually is the action step. That if you're doing your fiduciary duty well and hitting the marks, which I think financial advisors have been given a lot of financial products to do that and tools to do that, and that's been great. This is a developing tool set to do this for sustainable investors, and ultimately, more and more people will be interested in doing that. And the more they're interested, the costs come down, the impact goes up, the number of projects it spans. And it's very much the case that companies, and this is, I don't know exactly the timeline, but companies themselves trying to meet their own sustainability goals are going to be looking for financial markets that want to accept some of that liability for yield or for some sort of financial benefit. It would not be for personal points. It would be for yield in some capacity. And so it seems like you could have a world, whether it's not just carbon, but other types of credits that are fully traceable, and you can monitor the outcomes in nearly real time, but that we can start to put some pricing to those things over time. And that will be wild. That will be financial markets working in ways that they weren't imagining.
They incentivize doing good things. It's a market behind it.
Yeah, exactly. And it gives people the option, if they want to do it. And more people than we imagine will, because it will actually be fun. I've sort of marveled over the last 8-9 years with ESG investing. There's been a lot of different good products and things like that, but nobody from BlackRock to Goldman, any of these guys has really nailed it on the marketing side, and we can all say they're good at marketing. And I think it's because there isn't a definitive action step that you can try to poke holes in, but stands up. And the reason that hasn't existed is because it couldn't have until really the last couple of years. I mean, the cost to do stuff like this, it just wasn't.
And in particular, to verify it too, right? Like that got way more expensive. Yeah.
All of it was just not remotely. Maybe one of the few things that comes out of the crypto experiment has been the digitization of real world assets that actually have impact. And even that journey is inning 2. But I think that this is a place where you're going to see more and more stuff, and the integration of these types of portfolios with traditional portfolios, I believe is the path of sustainable investing going forward. And I think it sort of is the setup that once it's done a few times, the great marketers will unleash their abilities to do this, but they'll be using tools that are real. And I think that could be really wild, particularly outside the United States, because I think that would make investing a little bit more relevant in people's minds. Make money, have an impact, and also
attract U.S. money.
yeah.
What'd you say?
And then attract U.S. money.
That's right.
Yeah, well, the international stocks are outperforming U.S. this year, and a lot of it's because of the better growth opportunities there. Actually, I mean, and also it's been a long journey for international stocks versus the U.S. over the last 10 years, and some payback.
Yep.
Well, you mentioned like the BlackRocks, the Vanguards, the State Streets, whatever it may be, and why have they not marketed this? And
well, they've marketed it. They just, I would say, and it's not
the whole successful product. What we're starting to really do here is take this seriously. Like it's not paying lip service to something. It's not qualitative. This isn't investing and on a hope and a prayer that it's going to make change. This is putting the rubber to the road, pardon the cliche.
Yeah. And
one of the very important things about starting to behave seriously is having serious inputs. And so here's my plug for us, but Al, most accurate, freshest, most objective, most transparent ESG data. The reason we have been working with Conor so much and that we love this partnership is we give Conor really good data and Conor does these amazing things with it. And so for ESG investing or investing just to incorporate ESG, because that's what I think we're moving towards. And this is an example. Come check out Al's ESG data set and then go over and ask Conor what you can do with it.
Yeah. And that's the Owl and Confluence and companies like ours. We think highly of all our competitors, of course, but smaller companies have to get it right. And, and we do. And generally speaking, if we can come up with something innovative and get it going and it's a good idea, then it will be adopted by the bigger players. And that would be actually a huge compliment, because that means that this gets even more scaled and the experiment becomes a reality.
Yep.
We are all about returns and about taking things that people misunderstand or don't want to understand and see if there's any relationships. And that is investing. Whether you're doing ESG or some crazy quant thing or sunspots I mentioned last time, and a lot of people, it just came up yesterday on something else I was talking about. But there's a discipline, there's a lot of thought that goes behind it, but it's also very much that it has to work for all the investors, and then particularly have that added feature for sustainable investors. And so it's exciting stuff. It's been fun to see a lot of this net zero behavior starting to happen in the Middle East. There's an air carbon exchange that just launched in Abu Dhabi about a week or two ago. Outside the US, this is something that's already pretty far along in terms of pricing. What isn't as far along are all the tools that we discussed today and products that actually integrate these things. And it's going to be an exciting future.
It is.
Go ahead, Nate. Sorry.
No, it is. And I said, speaking of net zero, one of my favorite sports is Formula One. Right, I'm a Formula One nut since 2009. Way before this Drive to Survive thing came. But I always follow how they're dealing with net zero. From their perspective, right? And I always get made fun of by my buddies when I go to Formula One races. They're like, "Aren't you an ESG? Isn't this against burning all this fuel to go, racing around in circles. And I said, first of all, it's not a circle, it's a circuit. So get that straight. And second of all, the innovation just going into the fuel and all that they're doing is very interesting. So taking something like this and applying that even to, sports in your sports companies is something that's just been going on in the back of my mind as you were talking, going, wow, this could really help, lift the veil and let people see what's really going on, and not just hearsay or this is how I feel about it, or, burning fuel for Formula One cars is, detrimental at a zero sum level. No, there are things that you can do to help offset and to help actually, make the planet a better place. So anyway.
Well, people like cars and they like cars racing, and they've liked that for a long time. And I mean, just because you may not want to engage in it doesn't mean it's not happening. And so, we're all sitting in the same pew here, but like, you have to make usable products for the whole market and then make it adaptable for the people that don't want to be in certain things. But as we discussed, it's your choice to not be in certain things, and that's fine. However, it means that you need to be even more thoughtful about how you invest if that's the case. And that's, I don't think that that always lines up. I know we could produce great returns with a lot of restrictions, but that would mean that we would have to do a lot of active things, and that may not conform with someone's tax picture, right? So,
or again, we come back to cost. That could just cost somebody.
Oh yeah. The more we do, the more we could get wrong, but the more restrictive someone makes something. I ran a fossil-free ETF for a long time, and that was a fun experience. But what you discover is that people basically hate most companies, and and they don't even know all the bad ones. So it's an interesting place that managers and products can find themselves, because people really, really don't like certain companies for their very specific reasons. But when you have it all in a collection to make a return, it's an interesting dance to make it work. And honestly, the reason I think that no matter what you say on the return side, because as we all know, there's a paradox of if you do too well and you have an ESG fund, you get a lot of questions. And even if you have good answers, you still have a lot of questions. But I think that as we develop more and more of these tools, we can develop them in a language that institutional investors understand and are easy to adopt, and then have features and interfaces that are
not only understand, but can communicate to portfolio companies. Because if you're more active, if you're more engaged, you can forward your values without being restrictive. You don't have to hate companies. You're incentivized to like some of these companies. You just got to talk to them.
Yeah. You can engage more. Although the reality is that, look, you're Archer Daniels Midland. You're in the agriculture game. Like, you are going to produce 15 million metric tons next year, which is less than you did last year, and that's great. But it's still going to be carbon intensive, right?
100%.
And it's just
Warren Buffett can buy a $7 billion stake and go to the board and say, I just want you to buy some offsets.
Yeah. Well, I think that if we do a good job over these next quarters, then more and more people will start to integrate this in. And there's other opportunities. I mean, if you create a new market in the United States of America that people start to interact with, there's going to be a lot of other opportunities. And, particularly at the company and hopefully at the individual level. and I don't know how this exactly unfolds, but at the corporate level, you can imagine a sustainable fixed income market of some sort with a combination of carbon credits and projects and social impact and a whole mess of things, and trading at various yields so that companies can take long-term liabilities and finance them properly. And
you mentioned something that has been on my mind since we started working on this article. And I hadn't even thought of like the fixed income aspect of it, but just the idea of a sustainable investment market. What does that look like? And then further, and this is something for, maybe we get a roundtable go into spitball on this one, but what does it look like if people are shorting that or betting against it?
Well, most of the projects you wouldn't really, you're shorting a yielding project. There's not really, there wouldn't be much upside for you to do that. But especially since it's traceable. If you took an old project, you might be able to short like the credits, but you really can't, because the companies now, they're pretty in the news. Vera, there's a large Guardian article about all the bad things that carbon credits are about, and this, that, and the other thing.
I'll take a look.
Well, it's often cited, and I think the CEO of Vera was recently fired or left. And all of this is, the heart of it is that the credits just aren't traceable and audible as they need to be, in part because that's sort of an historical issue as well. I mean, it's not all nefarious. It's the carbon markets have existed for over 20 years. There's various types of projects at various levels of effectiveness and efficiency. Where things are absolutely going, as we talked about, is that these projects are having, sensors, satellite technology, lots of fairly inexpensive ways of tracking output, input, and otherwise an activity. And, that's just really just begun. But as that continues to roll out, then these credits of various sorts become very, very usable and very, very appropriate, really, for the action step. So it's exciting. It's something that cost-wise absolutely was not possible even 2 years ago. And I would say, I've been in the ESG game for a while. This will be a major leap forward in that regard. And when it finally gets to the big boys of Vanguard and Goldman, they will do a great job of marketing something that is real. And that will absolutely mean it will be mainstream, because they are good at sales. And they've got the distribution to prove it, right? So they just don't yet have the tools to do this. But anybody that looks at income investing and did a quick glance at what we're talking about here, they would get it pretty quickly. They may disagree with it, but they would understand it enough to disagree with it. And that's good enough.
Let him. Let's have an argument about it. That's a good thing.
Exactly. Let's have an argument about it. Oh, I didn't expect it to be that cheap, more or less, would be what a lot of people, when they really think about it, start thinking like, oh, like 20 basis points. I mean, that's not nothing, but it's not 2%.
It's that low because it's distributed amongst the market, and the responsibility is at the action level where the companies are. When we hear how expensive some of this regulation is because it's top-down umbrella, and it is that expensive. I mean, there's an economic analysis on this that says you're more than making up the cost of carbon or the cost of carbon risk over time. If things continue in the trajectory.
The other thing the asset management, this is going to probably happen a lot sooner than people expect, because the other thing the asset management business has a lot of is lawyers. And for the last 5 or 6 years, they have regulation lawyers. For the last 5 or 6 years, if you pick any of your favorite ESG funds, it doesn't matter what one, they produce a carbon footprint of their portfolio. They usually do it on a revenue intensity metric, but they do it. And what's interesting is they publish it. And I don't know that much about the law, but when you publish figures, they become a liability.
Yep.
And so that is basically where we find ourselves, is that we are not yet at liability stage, but we have all the components. So, probably some of the biggest practices of this actually occur in the pension space. So some of the largest capital has already a version of a carbon footprint of their portfolio and at their management level. And I think at first it was for record keeping purposes and this, that, and the other thing. But, you don't want to keep records of things you don't want to do. And that's that's where we're going to find ourselves pretty soon, is the doing. Now, the doing, to your point, Rob, can be done well, or it can be done expensively and clumsily and, not have a result. I expect that actually this will occur outside the US first and foremost, in part because it's somewhat already ingrained, in part because there isn't as much pushback against the very basic elements of crypto.
Concept, the words.
The word crypto is a problem. And also, look, markets outside the United States have to differentiate to the biggest market in the world. And as we talked about before, the US stocks have outperformed everything for the last 10 years. I mean, it's almost frightening how the outperformance. Well, if you are a market outside the United States and you have a new thing to sell in a better way and an audience that's willing, and I'm pretty much looking at the Middle East here and then Europe, and then subsequently Asia, I think that's what's happening. And if you have those same economies saying that they're transitioning from the thing that drives their economy to the next thing, whatever that might be, that's a pretty good indication that it's going to happen.
Yeah.
And it'd be wise to be part of it and help shape it. And Owl, Confluence, and a bunch of others are in the process of doing so.
That's what we think about all the time.
Yeah. Well, I mean,
best data, because we want to drive change, and you need the best data to drive change. Confluence creates these analytics to make this usable, to give you a way to invest.
People make money.
And make money.
Help people make money. And if you can actually have a lot of impact at lower and lower costs with higher output and more delight, to steal from Amazon here. But I mean, I think that is what's missing in ESG investing. Returns can generally speaking, almost all these products have tracking error functions on them, and they hit them. And what that means for people at home is, if the product is supposed to be within 1% of the S&P 500, guess what it is? And it's done so by design. It's a little harder to beat the S&P 500 and have a sustainability profile and keep a tracking error, but you can do that too. But at the end of the day, your goal there is very defined. It's hit the market with these metrics. Well, great, but your sustainable investor is looking for that other thing, because doing that all the time is great and expected, but boring. And it is, and that's great.
Sustainable investors, income investors, and any other investor who would just rather see portfolio dollars spent in ways that are considering the long term. Like Conor just said, you have the trifecta. You have happiness, you have increased output, and you have positive impact. The utility that forms would make any Econ 101 teacher real happy. And I don't think there's diminishing returns on that utility.
No, and if the ultimate scaler is Wall Street in the end, or clients and people, then if you serve it up this way, you will get an incredible result. If you give them the good inputs, they know how to scale. I am not BlackRock.
And here's the path. I think that's a perfect note to leave it on.
Yeah, absolutely.
Thank you both very much. I have an article on owlesg.com in the library. Come check it out. Concurrent to this. And as you can see, we're going to get Conor back on this a lot. It's interesting conversation.
Conor, thank you so much. I've learned so much just in this going, wow.
Well, hopefully, actually, next time we can tee up these carbon people, because I'm sure people are sick of looking at me, and they can talk at length about very exciting stuff that drives this. So, well, gentlemen, thank you.
Oh, our pleasure. Thank you for coming on, and everyone who took the time to listen. We appreciate it immensely. owlesg.com, the best ESG data you can get. Thank you for joining Armchair ESG with Nate and Yates, Conor Platt, Confluence Analytics. Y'all have a wonderful rest of your day.
Thank you, guys.